Today we're diving deep into a hot topic in the investment world, AAPU, the Apple Daily Participation ETF. This ETF has been on fire lately, surging a whopping 26% in just the past month according to ETF.com. That's a crazy good return, especially compared to the overall market. But before you jump in headfirst, there's a lot to unpack about AAPU. Is it a magical moneymaker or a risky gamble? We'll break down exactly how AAPU works, the potential benefits, and the crucial risks you need to consider before investing. So, buckle up and get ready to learn all about AAPU. By the end of this video, you'll know if it deserves a spot in your portfolio. Stay tuned. What is AAPU ETF? AAPU, ticker symbol for Direxin Daily AAPL Bull 2X shares, is an exchange-traded fund, ETF, designed to deliver 150% of the daily performance of Apple Incorporated stock, AAPL. This means AAPU aims to magnify the daily price movements of AAPL, both upwards and downwards. Here's a breakdown of AAPU's key features. Leveraged strategy. AAPU utilizes financial instruments like swaps to achieve its 150% daily return objective. This magnifies the daily gains and losses of AAPL compared to a standard, non-leveraged ETF that tracks Apple stock. Single stock focus. Unlike most ETFs that hold a basket of securities, AAPU concentrates solely on Apple stock. This exposes investors to the specific risks and rewards associated with Apple's performance. Volatility amplification. The leveraged nature of AAPU significantly amplifies volatility compared to AAPL itself. Small price movements in AAPL can translate into larger swings in AAPU's price. Short-term focus. AAPU is designed to track Apple's daily performance, making it unsuitable for long-term buy-and-hold strategies. Due to compounding effects, leveraged ETFs can deviate significantly from their target returns over longer periods. Understanding AAPU's mechanism. AAPU doesn't directly buy and sell shares of Apple stock. Instead, it employs financial instruments like swaps to achieve its leveraged return. Here's a simplified explanation. Daily reset. AAPU resets its holdings and leverage ratio each day. This ensures it delivers the targeted 150% daily return, regardless of AAPL's closing price compared to the previous day. Swaps. AAPU uses swap agreements with counterparties to gain magnified exposure to AAPL. These swaps essentially involve entering into a contract that mimics the daily price movements of Apple stock with 1.5x leverage. Describe AAPU's underlying investment strategy and its target asset allocation. AAPU utilizes a leveraged strategy to achieve its target of delivering 150% of the daily performance of Apple Incorporated stock, AAPL. This means AAPU seeks to magnify AAPL's daily price movements, both upwards and downwards. Here's a deeper look at the key components of AAPU's strategy. Leveraged exposure. AAPU doesn't directly buy and hold shares of Apple stock. Instead, it employs financial instruments like swaps to achieve its magnified daily return. These swaps essentially create contracts with counterparties that mimic the price movements of AAPL with 1.5x leverage. Daily reset. Unlike traditional ETFs that hold their underlying assets throughout the day, AAPU resets its holdings and leverage ratio each day. This ensures it delivers the targeted 150% daily return regardless of AAPL's closing price compared to the previous day. This daily reset mechanism helps AAPU achieve its objective, but introduces additional complexities. Replication strategy. AAPU doesn't use physical replication, where it would directly hold 1.5x the amount of AAPL shares to achieve its leverage. Instead, it likely utilizes a synthetic replication strategy through swaps. This allows for more efficient management of the fund but can introduce counterparty risk, where the reliability of the swap counterparty becomes a factor. Target asset allocation. AAPU's target asset allocation is remarkably simple and concentrated. Here's the breakdown. 150% exposure to Apple, AAPL. The sole objective of AAPU's asset allocation is to achieve 150% of the daily performance of AAPL. This means, in theory, the entire fund, net of fees and expenses, aims to be indirectly invested in instruments that track Apple's stock price with 1.5x leverage. Important considerations. Focus on daily performance. Due to the daily reset mechanism, AAPU targets daily returns, not long-term returns. The compounding effect of daily returns can deviate significantly from the targeted 150% over longer periods, especially in volatile markets. Dynamic allocation. While the target is a constant 150% AAPL exposure, the underlying holdings within the swaps used to achieve this leverage can change daily. Investors shouldn't expect to see a static portfolio within AAPU. What is the expense ratio of AAPU compared to similar ETFs? The expense ratio of AAPU is a key factor to consider when evaluating its suitability as an investment. It represents the annual fees charged by the fund's issuer to cover management costs, administrative expenses, and operational overhead. As of May 20, 2024, AAPU's expense ratio is approximately 1.04%. Comparison with similar ETFs. To understand how AAPU's expense ratio stacks up, let's compare it to similar leveraged and non-leveraged ETFs that provide exposure to Apple stock or the technology sector. Leveraged ETFs. Direxin Daily Technology Bull 3X Shares, TCL expense ratio 1.08%. ProShares Ultra Pro QQQ, UPRO expense ratio 0.95%. Non-leveraged ETFs. Invesco QQQ Trust, QQQ expense ratio 0.10%. Vanguard Technology ETF, VGT expense ratio 0.03%. Analysis. Leveraged versus non-leveraged. As expected, leveraged ETFs like AAPU generally have higher expense ratios compared to non-leveraged ETFs like QQQ or VGT. The additional complexity of managing leverage adds to the operational costs of the fund. Comparison within leveraged ETFs. AAPU's expense ratio, 1.04%, falls within the range of similar leveraged ETFs like TCL, 1.08%. ProShares Ultra Pro QQQ, UPRO, offers a slightly lower expense ratio, 0.95%. How does AAPU's sector allocation compare to its benchmark index? Unlike most ETFs that track a basket of securities within a specific sector or index, AAPU has a unique investment strategy. It focuses solely on delivering 150% of the daily performance of Apple Incorporated stock, AAPL. Therefore, AAPU doesn't have a benchmark index in the traditional sense. Here's a breakdown of why AAPU doesn't have a benchmark index. Single stock focus. AAPU concentrates all its holdings, indirectly through swaps, on replicating the performance of AAPL. This deviates from the core purpose of a benchmark index, which is to represent the performance of a broader market segment, e.g., technology sector, SP 500. Daily targeting. AAPU resets its holdings and leverage ratio each day. This focus on daily returns makes it difficult to compare it to a benchmark index, which typically measures performance over longer periods. Alternative comparison methods. While AAPU lacks a traditional benchmark index, some alternative comparisons might be helpful. Apple stock performance, AAPL. The most direct comparison is with AAPL itself. By tracking the daily percentage changes of both AAPL and AAPU, you can analyze how effectively AAPU achieves its goal of delivering 150% of AAPL's daily returns. Broader technology ETFs. You could compare AAPU's performance with ETFs that track the technology sector, like Invesco QQQ Trust, QQQ, or Vanguard Technology ETF, VGT. This provides context on how AAPU, with its concentrated bet on AAPL, performs relative to the broader technology market. What are the key risks associated with AAPU? AAPU offers the potential for magnified gains, but it also comes with significant risks that investors should carefully consider before investing. Here's a breakdown of the key risks associated with AAPU. Leverage risk. Amplified losses. The core risk of AAPU stems from its leveraged strategy. While it aims to deliver 150% of AAPL's daily gains, it also magnifies losses by the same factor. A small decline in AAPL's price can translate into a significant drop in AAPU's value. Volatility decay. Due to compounding effects, AAPU might underperform its target return over extended periods, especially during volatile markets. This is because daily losses are magnified and eat into the fund's overall returns. Concentration risk. Single stock exposure. AAPU concentrates solely on Apple stock, AAPL. The fund's performance is directly tied to AAPL's fortunes. If Apple experiences negative events, e.g., product recalls, management missteps, AAPU's value can suffer disproportionately. Lack of diversification. Unlike most ETFs that hold a basket of securities, AAPU offers no diversification benefit. Investors are exposed solely to the risks and rewards associated with Apple. Tracking error risk. Imperfect replication. AAPU likely utilizes swaps to achieve its leveraged exposure. These swaps might not perfectly track AAPL's daily performance due to factors like fees and counterparty risk. This can cause AAPU's returns to deviate from its targeted 150% of AAPL's daily movement. Liquidity risk. Less liquidity compared to AAPL. While AAPL is a highly liquid stock, AAPU might have lower trading volume and wider bid-ask spreads. This can make it more challenging to enter or exit positions quickly, especially during volatile markets. Are there any potential tax implications associated with investing in AAPU? There are potential tax implications associated with investing in AAPU, especially depending on your location and investment strategy. Here's a breakdown of the key considerations. Tax on capital gains. Holding period. Like any investment, selling AAPU at a profit will result in capital gains taxes. The specific tax rate you pay depends on your holding period, short-term or long-term, and your overall tax bracket. Short-term gains. Profits from selling AAPU shares held for less than 1 year are typically taxed as short-term capital gains, which are generally taxed at your ordinary income tax rate. This can be a higher rate compared to long-term capital gains. Wash sale rule. Short-term losses. If you sell AAPU shares at a loss and then repurchase them, or a substantially identical security, within 30 days, the wash sale rule might apply. This disallows claiming the capital loss for tax purposes until you repurchase the security and sell it after holding it for more than 30 days. What is the underlying structure of AAPU? Unlike traditional ETFs that directly hold the underlying assets, AAPU utilizes a synthetic replication strategy to achieve its target return of 150% of Apple's, AAPL, daily performance. Here's a deeper look at the mechanics. No physical holdings. AAPU doesn't directly buy and hold shares of Apple stock. Instead, it employs financial instruments called swaps to create synthetic exposure to AAPL's price movements with 1.5x leverage. Swap agreements. Counterparty involvement. AAPU enters into swap agreements with one or more counterparties, typically large financial institutions. These swaps essentially function as contracts that mimic AAPL's daily price movements. Daily reset mechanism. AAPU resets the swap agreements and leverage ratio each day. This ensures it delivers the targeted 150% daily return regardless of AAPL's closing price compared to the previous day. Mechanics of the swaps. AAPL exposure. One side of the swap agreement might involve AAPU agreeing to pay the counterparty a rate linked to the daily performance of AAPL, e.g., the daily return of AAPL or a basket of assets that track AAPL. Leveraged return. The other side of the swap agreement might involve the counterparty paying AAPU a return based on 1.5 times the daily return of AAPL. This achieves the 150% leverage target. Are there any specific provisions within AAPU's structure that could impact investors? Yes, there are several provisions within AAPU's structure that can significantly impact investors. Here's a breakdown of the key points to consider. 1. Leverage and daily reset mechanism. Amplified volatility. AAPU targets 150% of AAPL's daily performance, magnifying both gains and losses. This can lead to significant swings in AAPU's price compared to AAPL, especially during volatile markets. Volatility decay. Due to compounding effects, AAPU might underperform its target return over extended periods. Daily losses are magnified, eroding returns over time. Focus on daily returns. AAPU is designed to track daily performance, not long-term returns. This might not be suitable for investors seeking long-term exposure to Apple stock. 2. Swap agreements. Counterparty risk. AAPU relies on swaps with counterparties to achieve its leverage. If a counterparty defaults, AAPU might not be able to meet its obligations, impacting investor returns. Tracking error. The swaps might not perfectly track AAPL's daily performance due to factors like fees and potential differences in swap agreements. This can cause deviations from the targeted 150% daily return. Limited transparency. The specific details of the swap agreements, including the counterparties involved, might not be publicly disclosed. This can limit investor understanding of the underlying risks. 3. Expense ratio. Impact on returns. AAPU's expense ratio, which covers management fees, operational costs, and potential swap fees, eats into returns over time. A seemingly small difference in expense ratio can have a significant impact on long-term performance, especially when compounded. 4. Lack of diversification. Concentration risk. AAPU solely focuses on replicating Apple's stock price movement. Investors are exposed solely to the risks and rewards associated with Apple. A negative event impacting Apple can disproportionately affect AAPU's value. 5. Tax implications. Capital gains taxes. Profits from selling AAPU shares are subject to capital gains taxes, depending on the holding period and your tax bracket. Short-term gains, held less than 1 year, are typically taxed at a higher rate than long-term gains. Wash sale rule. Selling AAPU at a loss and repurchasing it, or a substantially similar security, within 30 days might trigger the wash sale rule, disallowing claiming the capital loss for tax purposes until you hold the repurchased security for over 30 days. Identify and compare alternative ETFs that offer similar exposure but with different characteristics. AAPU offers leveraged exposure to Apple's AAPL stock price movement. Here are some alternative ETFs that provide exposure to Apple or the technology sector, but with different characteristics. Alternative 1, Non-Leveraged Technology ETFs. Invesco QQQ Trust, QQQ. Tracks the Nasdaq 100 index, which includes Apple, AAPL, as a significant holding, around 12 to 15% weight as of May 2024. Offers broad exposure to the technology sector with diversification across various companies. Lower expense ratio compared to AAPU, typically around 0.1%. More suitable for investors seeking long-term technology sector growth without leverage. Vanguard Technology ETF, VGT. Tracks the CRSP US Large Cap Growth Index, which includes technology companies, but with a different weighting methodology compared to QQQ. Offers exposure to a broader range of large cap growth stocks, including Apple, AAPL, but with a potentially lower weight compared to QQQ. Very low expense ratio, typically around 0.03%. Good option for investors seeking diversified exposure to large cap growth stocks with minimal fees. Alternative 2, Moderately Leveraged Technology ETFs. ProShares UltraPro QQQ, UPRO. Tracks the Nasdaq 100 index with 3x daily leverage. Offers significantly amplified daily returns and losses compared to QQQ. Higher expense ratio compared to QQQ, typically around 0.95%. Suitable for aggressive investors with a high risk tolerance seeking magnified short-term gains or losses tied to the technology sector. Direxin Daily Technology Bull 3X Shares, TCL. Tracks the Technology Select Sector Index with 3x daily leverage. Provides leveraged exposure to a basket of technology companies, potentially with a different composition compared to UPRO, which tracks the Nasdaq 100 index. Expense ratio likely comparable to UPRO. Another option for aggressive investors seeking magnified short-term technology sector performance with leverage. The best alternative depends on your investment goals and risk tolerance. Long-term growth, QQQ or VGT offer diversified exposure to the technology sector for long-term growth without leverage. Short-term Apple performance, AAPU might be suitable for a short-term bullish view on Apple's stock price movement, but understand the high risks involved. Moderately leveraged technology exposure, UPRO or TCL can be considered for aggressive investors seeking magnified short-term gains or losses in the technology sector. Alright folks, that brings us to the end of our exploration of AAPU, the Apple Daily Participation ETF. We covered a lot of ground, from its impressive 26% one-month return to the underlying mechanics of leverage and swap agreements. Recap key points. AAPU offers magnified daily returns based on Apple's AAPL stock price movement. While it boasts the potential for amplified gains, it also comes with significant risks like volatility decay, counterparty risk, and lack of diversification. We explored alternative ETFs like QQQ and VGT for those seeking long-term, diversified technology sector exposure. Remember, AAPU is a complex financial instrument best suited for sophisticated investors with a high risk tolerance and a strong short-term bullish view on Apple. Thanks for joining us today. Don't forget to like this video and subscribe to the channel for more investment insights. We'll see you on the next one.